Gold surges over $4,300 an ounce. Australia's unemployment rate jumps to its highest rate since 2021, sending the Aussie dollar down against the Kiwi. And New Zealand dairy farmers are in line for bumper returns. That's coming up in our 5 Things in 5 Minutes on Friday, October the 17th. And then in our deep dive interview, ANZ senior economist Matt Galt looks at whether New Zealand's housing market might finally turn as the Reserve Bank looks to ease lending restrictions.
The sums are starting to add up a lot better for people looking to buy a home to live in or a home as an investment, given how far interest rates have come down.
But first, in 5 and 5 with ANZ, it's all about gold this morning. It rose another 2.4% to $4,300 an ounce overnight. ANZ commodities strategist Sunny Kamari says the US government shutdown, political problems in France and Japan, and falling US interest rates are all combining to drive the safe haven asset to record highs almost daily. But there is one extra major worry behind the demand for gold, says Sunny.
On top of that, investors are increasingly concerned about the Fed independence, and all these factors are contributing to the uncertainty, which is pushing gold prices to successive record highs.
So how high could gold go this year?
This price rally is unprecedented, driven by mounting concerns around Fed's independence. We see prices heading towards USD 4,400 per ounce by the end of this year.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was down 0.4% and the Nasdaq down 0.3%. The US 10-year Treasury yield was down 3.8 basis points to 4.003%. West Texas oil futures were down 0.2% at $58.14 US a barrel. The US dollar index down 0.3%. The Aussie dollar fell 0.3% to 64.85 US cents, although the Kiwi was up 0.2% at 57.30 US cents. That meant the Aussie-Kiwi cross fell 0.6% to $1 Australian dollar, buying $1.13.11 New Zealand dollars. Number 2, Australian employment grew 15,000 in September, slightly weaker than market expectations. But the big surprise came with the unemployment rate rising from 4.3% to 4.5%. ANZ economist Aaron Luck says that's the highest since 2021.
The 4.5% unemployment rate was certainly a surprise, and that's driven by a strong pickup in the number of unemployed people at around 34,000. Look, we don't think that the labour market is as weak as the headline unemployment rate would suggest. Employment picked up in the month, and hours worked also grew in September as well.
Number 3, Aaron says the surprise jump in unemployment will give the Reserve Bank of Australia something to think about.
The RBA will have a tough decision to make in November. Labour market has eased a little bit, but Q3 inflation will probably come in higher than they like, especially for services inflation. So given that, plus the fact that GDP has recovered a bit and consumer spending is a bit strong as well, we do think that they will hold the cash rate in the November meeting.
Number 4, the Aussie dollar fell following that labour market report. In particular, it was down 0.5% against the Kiwi on the day to that $1.13 mark, after several weeks of strengthening towards $1.15. ANZ FX strategist Felix Ryan says from here, the Kiwi typically strengthens going into the end of the year.
When we look at some of the factors featuring into that seasonality potentially, we also do see Kiwi exports typically pick up. So things like dairy, milk and meat, the key commodities there for the Kiwi economy, have tended to rebound after a bit of a slump in Q3. We also do see typically tourism pick up around the end of the year for New Zealand too. So, all those things do benefit the Kiwi dollar by extension, as well as the Kiwi economy. Of course, as well, we are seeing of that resurgence in US-China trade tensions in the last week. And that has typically been a more negative for the Aussie than it has the Kiwi dollar.
Number 5. It is spring, in the Southern Hemisphere at least, and ANZ Research's New Zealand Agri-Focus report is indicating fast-growing green shoots for dairy, sheep and beef farmers. ANZ Agri-economist Matt Dilly says dairy farmers in particular are looking for big payouts.
Probably the first thing that'll be on people's minds is a bit of debt repayment. While, this season is shaping up to be a good one and last season was really good, we did have a few difficult years prior to that. So I think debt repayment would be number 1. And then after that, folks would be starting to look at on-farm and off-farm investments.
Matt Dilly there. Now, in our deep dive interview, ANZ senior economist Matt Galt reviews the outlook for New Zealand's housing market as the Reserve Bank gets set to ease loan-to-value ratio restrictions.
The economy is still quite subdued. People's confidence in their jobs isn't very high at the moment, and interest rates have only really got back to neutral a short while ago, so they're now moving into a more stimulatory territory. But we would expect to see house prices gradually increase over the coming year, and our forecast for house prices next year is for them to go up 5%.
We also saw an announcement from the Reserve Bank that they will ease loan-to-value ratio restrictions in December. Do you talk us through how that might affect the housing market?
Yeah, so the Reserve Bank of New Zealand restricts the amount of high loan-to-value ratio lending that banks can do. The restrictions differ for investors and owner-occupiers, and it also restricts how much high debt-to-income lending can be done. Now, neither of these restrictions have been particularly binding recently. The debt-to-income restrictions in particular there's plenty of space in the allowance for banks to do high debt-to-income lending restrictions. But the Reserve Bank's had a review of their macro-prudential policy approach, and they've decided that given they put debt-to-income restrictions in last year, which they expect will become binding if interest rates reach particularly low levels, they don't think LVRs need to do quite as much work as they were. And so they've made a small tweak. It's not a big tweak compared to many of the changes to LVRs in the past, but a small tweak to move that to what they think are neutral levels.
Do you think these LVR changes would flow through differently to different regional housing markets?
Overall, I'd expect the slight easing in LVR restrictions the Reserve Bank's announced to have more of an impact over the medium term once there's more confidence in the housing market. At the moment, buyers are still being quite cautious and not really jumping into high LVR loans in the way they have perhaps at times in the past. So in that light, some of the markets where there's more confidence, such as Christchurch or Otago, perhaps the easing in restrictions might have more of an impact sooner than markets where there's less confidence. But overall, we don't see this as much of a game changer for our house price forecast. We see it adding a small amount of upside risk in the medium term rather than being a strong driver of the market.
So what do you think might drive that 5% house price growth that you're forecasting?
By far and away, the most important thing in our forecast is just the fact that interest rates have got to levels where we think they will start to put upward pressure on prices. The sums are starting to add up a lot better for people looking to buy a home to live in or a home as an investment, given how far interest rates have come down. And so we think that will gradually put upward pressure, particularly as lower interest rates help the wider economy recover and restore some more confidence in people's job security.
Matt Galt there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, October the 17th. Catch you next week with a look ahead to New Zealand's third quarter inflation data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.